Howdy, y'all. Welcome to the first episode of the ProVest Pulse. I'm very excited for this, Noel. I don't know about how excited you are for this, but I'm beyond excited to start something where just our clients are going to be able to see us and something that our clients get to interact with a lot more than their quarterly, semi-annually reviews. This is something that we get to do where if you have any questions, if you have any thoughts, we update you on things that are going on. And like the title kind of revolves around, we're giving y'all the pulse on what ProVest is doing and how the business is operating. So, Noel, I'm excited that you agreed to this. And
yeah, I'm excited about about what we're getting ready to tell people. This is something that we haven't done in a long time, and I think it's way past time that we introduce what we're getting ready to tell you about.
Yeah, and I'm beyond excited to talk about it. I mean, there are tons of things to go over in this first episode, so thank y'all for joining in and thank y'all for taking the time to watching this. So hopefully it's worthwhile. And yeah, let's get started. Real quick though, obviously with anything financial, we're going to do a quick little disclosure. If you don't mind pausing your video and going over the disclosures, that would be fantastic, just to get us started off. And real quick, what we're going to be going through today in this little mini cast, or the first episode of our little web show. Who am I? Obviously, some of you who are listening to this now have gotten the email where you've gotten a little bit of my backstory. I'll give everybody a quick rundown of who I am just because I am the new face in the room. Those who haven't read, this will be something new to you. Those who have read a little bit about me, it'll be really short. I'll go over the basic things and just to foundate your knowledge. And second thing we're going to be talking about is a model, a new ProVest model that me and Noel have been talking pretty extensively about and how we're going to implement it. And I'm excited to give you the basic rundown on it and have Noel's thoughts and talk to you guys a little bit about that. And after all of it, we're going to give you some thoughts on what we're trying to do with the show, what we're trying to aim for down the line, because this is something that is exclusively to clients of ProVest. So anybody who is a client is going to be getting this video, and it is going to be unlisted on YouTube, which means you guys, like I said, only you will have specific access to it. And if you know somebody that you think would benefit from this information or somebody that would enjoy this information, feel free to send them the link. What's fun about unlisted YouTube videos is that the link that we send you is transferable to people that you care about and that you know, but the public does not have access to it verifiably. So only you are able to share with people who feel like they would benefit from this. But yeah, let's get started. Real quick, the goals for the show, we want to do check-ins more often. I want to make sure that, especially coming on, I want to make sure that you guys feel a little bit more up-to-date on what's going on with ProVest. Noel has a monthly newsletter, and I love that. This is something that you guys get to see our faces, get to see a little bit about, you get to see the office colors every once in a while, and you get to a little bit of updates on what's going on with the markets. This show is going to be covering a lot of different things, and we're going to be relying on you guys to give us some topics you'd like for us to cover, whether that be the models, some opinions on the markets, or anything you want me and Noel to talk about. I'd be happy to talk about getting ready and planning for my wedding, or having Noel talk about what he had for lunch. It's all up for debate here, and we're all ready to talk about it. Second thing that I'm excited to do with this show in particular is with this new model, it's actually revolves a little bit about what I'm doing currently with my own investing portfolio. So this show is also going to give y'all a deep dive into my own investing account. This is just because this is something that I believe personally, where the cook needs to be eating his own cooking. I want to be able to show you guys what I'm doing in my own portfolio, where this is something that I truly believe in, and I'll give you updates on my thoughts on everything. Like I said, model and portfolio updates, that's what we're going to be using the show a little bit for, and just being a higher touch firm. And in general, I want to make sure that you guys know what we're doing day to day, and if you guys have any questions, you have a way to get that immediately to us in a bit more of an engaging manner, because sometimes a phone call doesn't really cut it. You want us to look over a graph, you want us to look over specific things online. Now's the opportunity to do that, and I'm happy to get started with it. Any thoughts, Noel?
Gabe, I've been looking for something that would be really, really good for clients, and the fact that you're looking at what people that have been so successful in investing, like Warren Buffett and others have put together, and you are emulating some of the ways that they're doing it. it just excites me. So I can't wait to get into it.
Yeah, I'm excited to get into it with you. And like, Buffett is somebody that I believe so much in, and the people who've read the document that we sent out a little bit about you introducing me to the firm, somebody or people who go back to that document will see that my first stock was, I don't know if I'm able to say it, but you can see the first stock that I invested in, and you know exactly what the purpose of that was, because I'm a Buffite, and Buffett really heavily invested into that company, and that was the first thing I truly believed in based on everything that I learned from him. But yeah, that goes back to when I was 15 and starting to get interested in the markets. But let's get a little bit into that. Those who already know me, I'll make this really brief. Began investing around 15 just because, and this is something that I got into it because of my dad. He started out as a stockbroker early on in his days and then worked up to his way where he currently is now. And he's always sprinkled some wisdom upon me whenever he saw that I first was interested in the market. So I took that constantly and ran with it. Learned a lot about Ben Graham and Tom Hayes, who we'll talk a little bit about later. But my investment philosophy comes a lot into the foundation of value investing, but value investing with a twist. And I'm excited to get a little bit into what that specifically means. Obviously, graduated from Commerce, really local to the Spartanburg area. BS in economics, currently getting my master's of science and management and economics at Warner. Very excited to get that done, even though that might be an extra water hose that I'm drinking out of right now while everything else is going on. But it's something that I'm learning a lot as well. I'm really interested to talk a little bit about the lineage that I've learned from. Everybody knows that Buffett, to me, might be, and for a lot of people, he is the greatest investor of all time. And there's a couple of reasons for that. Nobody has been able to compound wealth like he has. While you've seen Ben Graham create value investing, we saw Buffett take it a step further and look for great companies at great prices, not just buying cheap for cheap's sake, which was something that Ben Graham believed in. And then somebody that I follow pretty regularly, Tom Hayes, takes it a step further, which we look at an extra couple of different categories and what goes into a great company at a great price. What does the management look like? What does the books? I'll talk a little bit about that, but very basic rundown. These are the three people that I heavily invest my framework around and heavily believe in and learned a lot about. Me particular, so this goes into the model a little bit. My specific belief about investing is, I talked to Noel about it, and this is why I included it into the PowerPoint. My investment philosophy is I invest a little bit similarly to how you see private equity invest. So I invest like private equity, but in public markets. So essentially what I mean by that is I would not, if I'm going into a position, if I would not buy and I would not put all of my money, all of my net worth into that company, I would not buy it. So that filter on its own eliminates a lot of the stocks that people might invest in. I don't chase shiny objects just by them being shiny. Obviously, we all know the AI race right now is the biggest thing since sliced bread. And
what is the shiny object today, isn't it?
Yeah, and that goes beyond AI, crypto. Any of the Mag 7 right now, you'll see as the shiniest objects that people want to hop into. So I'm trying to avoid a lot of that noise and look for the value based on the fundamentals of the business. And we'll talk a little bit about that. The model that I'm working with Noel is it's concentrated. There's still diversity and diversification around it, but it's a concentrated position to where each position that I'm entering have done very extensive research on, very thoroughly have looked through each steps of the company's books, management, liquidity, moat, as well as a catalyst. And I'll talk a little bit about that in particular, but that's the catalyst is something that really needs to be present in order for something to be interesting to me and to see a displacement between the book value and the public market value. So a lot of it kind of boils down to long-term outlooks on the business compared to what the short term might look like currently. I personally believe in buying on weakness and selling on strength. A lot of people view that oppositely. And no, we talked a little bit about this earlier, but people, whenever they see a stock rise, they think, oh, less risky. It's less risky now because it's raising in price. I can get into it and get a return out of it.
And quite frankly, that is a very logical way of looking at it, because we are, as humans, linear thinkers, and we tend to think if something's going up, that will continue to go up, and on the opposite, if it's going down, it's going to continue to go down. That's the way we've always thought. That's the way we are as humans.
And something that I've read a lot on with Buffett and Benjamin Graham was when the price actually decreases, while there is some circumstances on maybe it's a permanent thing that impacted the business where, let's say Kodak, for example, the little digital cameras, I know you remember them. That was a thing in the past for me, but Kodak got displaced completely and the company is gone. So there's instances like that where the share price goes down for a very specific reason. But when some of the times, whenever the price decreases by a substantial amount, it's actually de-risking the asset. So while something like a company that I'm looking at personally is a generator company, something that homeowners buy generators for backup power that also are providing generators to data centers. That position is currently down 80% from its all-time highs, and that's a position that I've been in since about 7 months ago. And so far I'm seeing a decent amount of return from that, just because while generators aren't the sexiest thing in the world to invest in, we're all going to need power. So why are people not looking at this in particularly? Well, it's because data centers are more sexier than generators itself, but what's powering the next step? So that gives you a short and condensed version of what I believe in that. So, and I'll read this quote because it's one of my favorite quotes from Buffett. Great investment opportunities come around when excellent companies are surrounded by unusual circumstances that causes the stock to be misappraised. So we all know public markets. What I'm looking for is revenue that goes like this over time. I'm looking for free cash flow of companies that go like this over time. I'm looking for stocks that are misappraised in a sense where the value of the company goes beyond what the market sees it as. And so I'm excited to talk a little bit more about that down the line. I'm giving everybody a very basic overview of that. And if you're interested more in talking a bit more about it, be more than happy to hop on a call with you, and Noel will be happy to talk a little bit about it. But any thoughts so far?
I think the things are, that you're explaining it beautifully, but I'm excited about getting into the rest of it because I know that's where the excitement is.
To say the least, yeah. So real quick on what I'm specifically trying to aim for, especially in this model, is a lot of people will look at, the models that Noel uses were actively managing in a sense where it doesn't matter how long we've been in the markets. If an indicator changes, then we're going to be transferring assets depending on those indicators. So it could be all in the markets for a couple months, a couple of years in extreme circumstances. It all depends on indicators, right? For me, I'm taking a much more long-term view of the market, and depending on the positions that I've done research on, which ones would most likely, and I put it most likely into parentheses because I've been willing to bet my life savings on it, will 2 to 3x over the next 2 to 4 years, around those timeframes. That's about the average that I've had, the positions that I've had in the past.
How much will they grow? You say 2 to 3x.
Yeah.
Reasonable or triple in price.
Yes, from the current lows where the cost basis is set. So a big one, let's take, for example, I bought Google back in 2021 whenever it was down. I think it was about $90 to $95, right? So I bought in. The stock still decreased because a lot of public sentiment wasn't too high about it. Everybody saw AI starting to chip away at Google. There was a court case around it they were trying to break up Google because they did believe it was a monopoly. I knew that while AI was coming into play, everybody uses Google in some shape or form. Waymo, YouTube, those are all under the same umbrella, and revenues have not stopped going upwards. People have not stopped using YouTube. People have not stopped using Google in general. So I believed in that case and I believed in that company. That present day, if you look at Google's share price today, I think it's close to $300. So while I'm out of that position completely now, I'm looking for opportunities to where I just need the book value of the company to reach where it should be in the public markets, and then I'm backing out. Just to give you a sense of what I'm trying to aim for. So 2 to 3x in about 2 to 3 years per position. I'm not going to say the entire portfolio is going to 2 to 3x, because depending on where I believe each position is at currently in the markets and the life cycle of the business, because some of these companies that I'm interested in are very cyclical. So depending on the business cycle that we're going through, depends on the positions that I'm in, as well as how long I will be in those positions. But with that long-term time horizon, I do want to cover the fact that in the short term, volatility is very natural. I think the last month have shown us that. Whenever we got in April, we've shown that in the short run, and I like this quote from Ben, in the short run, the market is a voting machine driven by emotion, and the long term, it's a weighing machine driven by fundamentals. And that's something that really gives you an insight on, if you zoom out on any kind of graph, whenever we're looking at markets in general, there's a clear distinction of where it's going depending on, or there's a clear distinction of where the markets has been going since the inception of the S&P 500 or the indexes that have taken the weighted average of the indexes. So that's my opinion on it. So 2 to 3, I want to cover the time horizon real quick. 2 to 3 years is the holding period for me, particularly because of the fact that's the sweet spot to where you see a lot of institutions leave their positions and they won't stick around in those positions for very long, because they use a lot of leverage to increase returns. So what I'm trying to do is play the time arbitrage game. I can wait a while for these positions to start playing out into my thesis. And once that game plays out, I mean, most of the time people start buying in whenever, we talked about earlier, whenever it starts to rise in price. That's when we'll get to see big institutions get back to hopping on it, because then they believe that, well, the company is now looking better, so let's get back onto it. And that's where it starts to multiply a little bit. I'm going to talk about this a little bit in the next slide, but temperament over intellect is something that I've talked with my dad, funny enough, a little bit about whenever I got into the industry, because I believed personally that I needed to be a certain IQ to enter the industry. I needed to be a certain amount of book smarts or street smarts, whatever you want to call it, to actually succeed. And from a lot of advice that I've gotten, that I've read, that my father has given me, it all comes down to temperament, and we'll talk a little bit about that in a second. And I also want to reemphasize that this strategy, we're looking for positions that go down. I'm going to take a little estimate here because this is something that I've done with my positions. So my positions, I look for companies that are down about 65 to 80% from their all-time highs. Then I start my investment process on, okay, what does the management look like? Are they people that really care about their shareholders? What does their book look like? What's the moat? What's the catalyst? We'll talk a little bit about that later, but depending on where the position's at currently, that's what I look for. This is something that really changed my idea and the belief of what a good advisor could be, because even the smartest people in the world still fall for human nature, and the South Sea bubble is a perfect example of that. Noel, what did Isaac Newton do? What did he contribute to society?
I think that Isaac Newton is responsible for not discovering gravity, but for making it scientific.
So what if I told you that the person that made his thesis around gravity, that created calculus, still suffered from the fear of missing out and market greed? Would you?
I would say that I would not be surprised.
So at the
I
end,
would be surprised because it is a basic human nature.
So this was something that really kind of keyed me into, with as smart as people can be. Everybody thinks that they want their money manager to have a 190 IQ, the 180, 190. They could be the smartest guy in the room. My response to that would be, well, let me see them under pressure first. How will they act under pressure? Because a lot of what we are in this business is, and especially with my investment philosophy, is it's time. I have time on my side, and I can look for positions that I know the business is strong enough to last 2 to 3 years from that investment philosophy, and we'll look for the return that I expect in the future. So real quick, Isaac Newton fell into the South Sea bubble, which was a trading company back in the day. That stock rose exponentially quickly. He doubled his money. He got out, but then his friends stayed into the stock. He saw his friends getting richer than he was, and then he thought, well, I don't want that. So he then reinvested with a lot more money, which were a lot of the gains that he made previously. And the stock kind of says it's for itself. I mean, it crashed horrifically, and he had to exit with an insane amount of losses and essentially got out broke. So the investor, and what I'm trying to emulate with this is the investor who can stay calm during these storms and knows what he's aiming for at the end of the day, what we're trying to accomplish for you as clients. That gives us the reassurance that what we're doing is correct. Short-term volatility does not matter. Chasing shiny objects like Newton did with the South Sea bubble, not interested in what I'm doing at all. This is something that I truly believe in and what I know will happen down the line. I can be wrong. I've been wrong in the past, but from my account positions to where I started to now, I'm more successful than not. So the 4 filters I want to cover real quick. I'm happy to discuss a lot more in depth on what these mean if you guys are interested in something like this. But the 4 filters that I look at whenever I'm talking to Noel about a potential investment strategy is they need to be solvent, liquidity, balance sheet, cash flow needs to be strong enough to where I believe the company will last as long as they will for my thesis to play out. Something that I'm real quick. Will Cambridge allow me to say certain investment?
I think that you can mention companies.
Okay.
You want to, but you've got to disclose whether or not you're investing in them.
Okay. So strong balance sheets and liquidity profiles that allow the company to survive long enough for my thesis to play out. And I want to avoid dilution or distress when it comes to that. What I mean by that is I'm looking for companies that have a lot of debt. And why I say that specifically is we're actually seeing this play out with the Mag 7 and a lot of these big tech firms. Free cash flow of these companies have gone negative because now they're taking on debt to build up data centers. The margins are starting to become a little bit scary compared to the money they're generating from the debt they're taking out. So I'm trying to avoid companies like that altogether. Do they have more debt than they do revenue? Or are they issuing more shares to try to dilute out shareholders? These things are something that I take in consideration pretty often. I want to look for stable margins, companies that have consistently improved revenue over time. If they have a dip, why? These things are gone over pretty extensively in my head. Second thing is I'm looking for great management. I want people to have skin in the game, essentially. Whenever you have a partner going into this, you want to know that they have your best interest at heart. So a big thing for me is if the key management has an indicator of success, whether that being they have to hit certain goals to get their bonuses or their stock-based accounts, they have to hit these goals in order to get their money. So what does the management have to earn? What does the management have to get to help the shareholders that are in that company play out with them? Essentially is what I'm looking for, right? And with management, I also want to keep track of where have they been in the past? Where has their track record been? Have they been successful? And for lack of a better term, I'm looking for people that aren't scumbags that will come into a company, add a bunch of shares to dilute people and put more money in their pocket. Trying to avoid things like that. Oh, it sounded like you were going to say something. Are you say something?
I was just going to mention the fact that that you don't want a company that's creating more shares. Actually, you like a company that is buying back their shares to increase shareholder value to the shareholders that are holding on to the stock.
100%. And that's something that I'm looking for as well. So I'm glad you brought that up. And third thing, durable business moat. Do I believe this company will stick around for the next 15, 20 years? I used to be invested in Coke. I'm no longer invested in Coke, but that business moat, no matter what happens, if God forbid, World War III happens, if the AI starts to become more prominent, I think we can all confidently say that Coke is going to be around a lot longer. Nobody's going to drink less Diet Coke because something is happening into their life. They might increase a little bit just to feel good about themselves. So, do they have a big enough moat around their company? Do they have any competitors? If so, what are their competitors doing? I'm looking for durable advantages in companies that I'm looking for. Last thing, and this is something that is really, really important to my philosophy, even though if these three things prove to be true, I need this fourth one to be present. And that's a catalyst. A catalyst for me technically is an indicator that they have started the process of turning something around. Warren Buffett and
Charlie Munger?
Yeah, it's Munger. There's something that Charlie Munger said that really stuck to me. Show me the incentives and I'll show you the outcome. What are the incentives? So I can then possibly predict the outcome. It works like business. If you give an employee a certain objective to hit and a big enough bonus to where that becomes an incentive to him, there's a higher probability that he'll succeed. So that's something that I'm looking at specifically to build around. So like these are the specific questions that I ask per filter. What I'm trying to do throughout these questions is I'm trying to find a reason to not get into a position. I'm not investing to invest. I'm investing in a turnaround story that proves it's going to be successful in the long run. I don't know that for 100% certainty. I cannot guarantee that. But do they have enough backing in their balance sheet, their management, their business that can show me that this is something that I truly believe in? I think during my time doing this, I don't know the exact number, but it's been a couple thousand. I want to say it's about 2,000 to 3,000 different stocks that I've looked at using this framework. And based on those 2,000 to 3,000, I think only about 30 have passed the four filters that I'm looking for since I've started this back in 2021. And it's been something that I'm trying to find. I'm trying to find a reason not to get into a position. Because that's, if I'm willing to bet my entire net worth on this company, if I would not buy the entire company, I'm not going to enter that position and I'm not going to buy their stock. I need to make sure that I believe in something. So could this company survive a prolonged downturn? I want to stress test the balance sheet. If the debt is the main risk, I want to see a clear funded path to deleveraging. I want to make sure management has skin in the game. Don't want people that are just desk sitters and don't do the job that they're hired for. I want to find a real defensible moat around the company. Do they have a big enough market share? Are they a key provider? Would the economy essentially suffer if they were to just disappear overnight? And then last thing but last is I want to find a specific catalyst around this. I want to find something that will trigger me to find a reason to get into the position, whether that be new CEO, assets that have changed, a new cycle in the business, something that closes the gap between the book value and the market value, or I guess in this case, the book value and the market value from where they are. I want to cover this real quickly. I want to avoid, with my style in investing, there's certain precautions I want to take with managing risk. Leverage is something that I will never use in this portfolio in this model because of the fact that we are playing the time arbitrage game, not trying to maximize gain here. These are companies that will have to play out the thesis over time and have done so in the past. There's another presentation I think we're specifically developing for people that are more interested in it to show you what has played out in certain stocks that I've personally invested in. I've shown Noel. So these are something that take time to accumulate a good return in. Second thing is we're looking for financially stable businesses. They have to meet a certain criteria of assets over liabilities to make sure that they are solvent. Diversification. The model that I'm thinking about producing will be around 8 to 12 concentrated positions. And the reason I say 8 to 12 is because as soon as you get above 12 individual stocks, I forget who the research company was that did it, but it actually becomes harder to outperform the market if you add more stocks into the portfolio. So this is something that I'm going to say is a bit more risky for investors. It's something that will carry risk, but at the end of the day, the companies that I'm looking at, if they were to, even if in this small modicum of possibility, if they were to file Chapter 11 bankruptcy, they would be giving their principal back to investors. They have to get their secured debt, unsecured debt, preferred stock, and then the common stock. Based on their balance sheets, they have more than enough assets to cover all of that principal back. None of the companies I've done that have declared bankruptcy, but even if they were, this is something that I'm fairly confident in. If a single holding went to zero, the remaining portfolio must not only recover the loss, but still outperform the S&P 100 net of fees. I want to make sure that this is something that produces a return over time beyond what you would just get into the market. So I'm doing a bunch of math to figure out what that will look like in the long run. Model what you don't know. I mean, I'll say this again. There's things that I don't know that I don't know. A meteor could strike a factory next week, a VF Corp, and that would destroy the position. There's certain things that I don't know that I can't know. So being able to diversify to a dozen or more different positions is necessary in order to reduce the things that I cannot control at the end of the day. No matter how much research I do, somebody could accidentally set fire to the entire clothing brand and it's poof, gone. So I can't control the things that cannot be controlled. But I have the confidence that this is something that has played out for me in particular and will continue to play out. So I'm looking for the confidence to outperform, but the humility to acknowledge the unknowns that will happen. We want to make sure, especially with this model, what are the outcomes? What are the outs that we can take in the business? If we can get out with a simple return 2 to 3 times, then we're taking that and running. We don't need a massive return. The ways that we want to find ways that we can still be wrong and still win, multiple paths to a positive outcome.
Gabe, if somebody's considering investing with you to put their money in something like this, when they first invest, what do you think they should be able to expect?
Like I said, this is something that I've been playing out this is a model where I expect it to play out in the next 2 to 3 years. So if you do decide to go with this, you're taking a long-term approach with it.
What you're saying is, if you first put your money in, you can actually expect it to go down some, because what you've been looking at, if you were to look at that VF graph again, you've been investing in along the line for a few years. You started in 2023, and it hasn't turned around yet. And so what you've got to have more than anything else in investing in this way is you've got to have some patience, where they are producing and they are trying to grow their brand. And when you've got something that's gone down like their brands have, or the corporation has, then what they're looking at is a time that it takes for it to turn around. And now you think they've got the right management that can do it.
With a new company, they had to deleverage, they had to sell off some business, and they had to become.
So basically, we're pushing forward right now and making things look better.
Yeah. I mean, it doesn't feel great to investors because the fact that they have to sell off assets to make their balance sheets better. But the price to book compared to where it's at in the market to where it is on paper, they are not priced to where they're supposed to be. So this is something that I'm looking at consistently, even with recent volatility. I'm more than confident that this is something that will turn around, and you can quote me on this whenever 1 to 2 years down the road if this starts to play out. If it doesn't play out, then I'll take another arrow to the chest and say that I got one wrong, but out of the times that I've done this, I've maybe had 2 wrong and 23 others that have worked extraordinarily well. So this is something that I'm keeping track of very consistently, and I know that this will play out in the long term.
Yeah, I'm looking forward to getting this started for myself.
So I do want to say that there is a presentation that me and Noel have been working on that goes into a lot of the deeper complexities of this model, and we'd be happy to talk about it. But besides that, this is the show that we are wanting to start to produce bi-weekly and make sure that we're doing a show every other week, where if you guys have any questions, if you guys want an update on what we see in the markets, certain news, models, anything big or small, we'd ask for you to shoot us an email and have the subject line, make sure it's Q&A or the Ask Me Anything question that we can put it into the show, and we'd be happy to add it into our deck and fire away and talk about it.
I'm just glad to have you here, and we're doing some new things that are really, really exciting. I'm looking at this year as a fabulous growth year for our company, and I think we've got something we can talk to our clients about that's going to be just so exciting for us.
Well, I'm excited to work on it. This is something that I've been doing for a while. Never really thought about making it a professional space, but I'm happy to bounce off ideas with you. And this is something that I was surprised that you liked, and I'd be happy to work around it. And I'm here to make sure that the clients are as happy as they can be. And
anything we can do to give our clients a better rate of return, to make them happy, to do a better job for them. This is what I want to do. This is what I want. This is what I want ProVest to be known for.
Can't agree more. And I'm excited to be part of this story. Well, y'all, first off, thank you very much for sticking with us for the hour, and thank you very much for tuning into the show. We really ended up listening the entire way through.
We'll be back.
And we'll be back with another show. If you have any questions, please take note of our emails and send in a question or ask us what we would like to cover next time we do this in the next couple of weeks, and be happy to get started.